Good evening, everyone. So welcome to our revision class today. So we're revising on taxation of business income. So I want to review a few questions on business income. And if time allows, we'll also look at another area. So basically, when it comes to business income, there are a few things you need to know. You need to know what we call taxable business income. Those items that are considered to be taxable from business income. So one is a gain arising from buying and selling. So when you buy and you sell, the difference, the profit that you generate from buying and selling, maybe you are buying commodities or you are selling services. So the profit, the gains from that kind of activity, they are taxable. And then when you receive insurance compensation for the loss of revenue items or stock items, that one is also considered as taxable business income. Foreign exchange gain is also considered as taxable business income. If the question writes miscellaneous income is also considered as taxable business income. Discount received is also considered as taxable business income. So those are majorly the taxable business income. That is income arising from the trading activities, compensation in relation to the business, inventory items, and revenue items. That is considered business income. You're also supposed to know non-taxable business income, what we call non-taxable business income. Non-taxable incomes. So one thing you need to know is that the income statement that is prepared for accounting purposes differ with that of taxable of the tax purpose. The income statement for the internal income statement that is prepared for accounting purposes is different from that one that is prepared for tax purposes. So for the purposes of internal affairs, they even consider some other income that the taxman does not consider to be taxable. So we call them non-taxable income, maybe a gain arising from disposal of capital items. A gain arising from disposal of capital items is not taxable, it's non-taxable income. So that one is not considered as taxable income. So when you sell non-current asset at a profit, that one is not considered as taxable income. And then there is what you call unrealized foreign exchange gain. Foreign exchange gain, this one is not taxable business income. Unrealized foreign exchange gain. So when you're trading internationally or you're using different currency than the Kenyan currency, sometimes the currency favors you and you gain. So this gain, until you receive it, is not taxable. To unrealized means you've not yet received the gain from the foreign investment as a result of foreign exchange activities. So unrealized foreign exchange gain is non-taxable business income. And then compensation from insurance company for loss of capital items. So when you lose capital items and then you are compensated for that, it's not taxable business income. And then another non-taxable business income is sale of shares. Sale of shares is non-taxable business income. Issue of debentures is non-taxable business income. Issue of debentures, and then reduction in general provision for bad debts. In general provision for bad debts. So there's what we call general provision for bad debts. So when it reduces, it is not, for accounting purposes, it's considered as income. So remember, provision is just an amount that is set aside from profit to cater for bad debts. So this amount can be, you can set for instance, 20,000 in a particular period. And then from analysis, you find that debtors are paying more and more. So there's no need to hold this money in that account of provision for bad debts. So you need to reduce amount by 10,000 to bring it back to circulation. So ordinarily, when you do that for accounting purposes, that one is considered as taxable business income. But when you do it for tax purposes, is not taxable business income, is not. And then another thing that is not taxable business income here is recovery of bad debts in relation to capital item. So when you recover bad debts that you for the sale of capital items, that one is not taxable business income. So you need to know that. Then very important also is what we call allowable and disallowable expenses. So allowable expenses are those expenses that assisted you to generate taxable income. And basically most of them are of revenue in nature. So those ones are allowed by taxman to be deducted from your gross income. However, for accounting purposes, they consider a variety of expenses, including some that are not allowed. So there are some expenses that are not allowed. So it is very easy to know disallowed expenses. So if you get that the question that you are disallowable expenses, so when the question has given you the net profit, for you to adjust the taxable income, you need to analyze all the expenses that were deducted. Those that are not allowed, we call them disallowable. You add them back to the profit that you're given. So there are some expenses you need to know of. We call them disallowed. One of them is depreciation. Depreciation, impairment loss, or impairment loss. Impairment refers to the loss of value of intangible assets. Depreciation is the loss of value of tangible assets. And then capital acquisition. When you acquire a capital item, the amount of money that you use to acquire a capital item is not allowed. Number 3, personal expenses are not allowed. Personal expenses. Number 4, taxes and any expense related to tax. Any expense that is related to tax is not allowed. Tax and any expense that is related to tax is not allowed. Number 5, donations, except donations to charitable institutions. Charitable institutions, we're talking about mosques and churches and children's homes. Any other donations, maybe to a relief fund or to any other donations, are only allowable if they are to a charitable institution, to a mosque or a church. Any other donations are not allowed. Donation to political party, for instance, are not allowed. Donation to farmer and relief are not allowed. But donation to a charitable institution, to a children's home or Red Cross, that one is allowed. But donation to a farmer and relief is not allowed. To a political party is not allowed. Number 6, penalties and fines. Penalties and fines not allowed. Number 7, penalties and fines are not allowed. Number 7, legal costs. Legal costs in relation to lease agreement of over 99 years. That one is not allowed. Legal costs in relation to a lease agreement over 5 years. Items like cash embezzlement by a cashier or one of the workers, that is not allowed. And among others. So you need to have a clear grasp of allowable and disallowables, and then taxable and untaxable income. Once you have that, these questions are very easy to do. So we want to look at a few of them here. Both partnership and company. So we want to start with May 2021, question number 5C. May 2021, question number 5C. So block revision, May 2021, question number 5C on partnership. May 2021, question number 5C. So our first question is May 2021, question number 5C. This question was done last sitting, and it is on partnership. So we're going to read the question and do it together. In case you don't have the question, you can just be attentive And then you can request for it immediately after the class. You can call me and then I can forward the question to you. But in the meantime, you can just be attentive, follow up, and maybe you can ask a question if it's something that you don't understand. So I read the question. Mark and Wangu are in trading partnership operating as Mwaha Enterprises and sharing profit and losses in the ratio of 2:3 respectively. So the following statement of profit or loss was prepared by the business for the year ended at 1st December 2020. So we've been given there the profit and loss. The profit and loss, I know it constitutes of incomes and expenses. And then you have been given there the net profit of 99,4,500. Additional information number one says gross sales include VAT at 14%. In addition, 10% of sales before VAT represents closing stock. The stock has been overstated by 20%. Note number two, the amount due to partners are to be apportioned according to profit or loss sharing ratio. Number three, general expenses comprise partition of business premises, 64,000, debt collection expenses, 36,000, purchase of office stationery, 14,000, cash embezzled by partner's wife, 48,000, bad debts written off, 24,800, business premises rent, 31,200, salaries to employees, 106,000, total 324,000. Number four, legal expenses include acquisition of patent rights, 24,800, drafting of sales agreement, 34,200, negotiating sales contract, 60,000, drafting the business against trade disputes, 42,600, defending partners against wrong tax assessment, 94,600, conveyance fees for business premises, 125,800, tax consultants fees, 72,500. Number five, the purchases represents 40% of the gross sales figure of 2,736,000. The purchases had been understated by 25% and were omitted from the income statement. So required, required Roman number one, adjusted partnership statement of profit or loss for the year ended at 1st December 2020, 8 marks. And then number two, the allocation of profit or loss computed is here above to each partner, 4 marks. So they want us to adjust the taxable profit. So you write the title. The title is More Enterprise. More Enterprise. More Enterprise. More Enterprises. Computation of taxable profit. Computation of taxable profit, year of income, 2020, and then you underline here. So here you can write shillings. So now, when you're doing this kind of question, the first thing you check is whether they have already given you the net profit. The question has already computed the net profit for you, or you are the person now computing the profits, the gross profit. If the question has given you the net profit, you will add back disallowable. So you'll analyze the expenses deducted in arriving at the net profit, and then those ones that are not allowed, you're going to add back to the net profit. If the question wants you to compute the gross profit, you'll compute the gross profit and then identify other taxable business income you add to the gross profit. and then you pick allowable expenses amongst the list of expenses you'll be given. So here, the question has already given us the net profit. So we start with the reported. We start with the reported net profit. It can be profit or loss, irrespective. Just put the figure here, 994,500. If it is a loss, you put in bracket to indicate that it's a loss. So the reported, and then you go back, you add disallowable, deduction. So these are deductions that were deducted in arriving at the profits, but they're not supposed to be deducted. So how do you identify this one? So you go directly to the expenses deducted. So there, the income statement, they have clearly indicated the less expenses. You can even ignore additional notes. So once you pick expenditure there, you check alongside the additional note if it's if there is any note affecting that particular expense that you picked. Once you pick a particular expenditure, you either certify it as whether allowable or disallowable. And besides, you also check alongside the additional notes to find out if there is a particular note that is affecting that particular expenditure that you're dealing with at that particular time. So the first expenditure there is general expenses. Ordinarily, general expenses is allowed. So you check if there is any expenditure, any note, sorry, that affect that general expense. Like the note number 3, we have general expense comprises of partition. So you have been given the breakdown of general expense, what it comprises of. So it comprises of partition of business premises. That one is not allowed. Partition is a capital item. So you add back partition of business premises. Partition is not allowed. So you add back 64,000. That one is not allowed. And then it also comprises of debt collection expenses. That is allowable. That is related to business. And then purchase of office stationery. Office stationery is allowable. It's related to business. And then cash embezzled by partner's wife. So embezzlement is not allowed. Embezzlement is not allowed. So cash embezzlement. Cash embezzlement is not allowed. The amount is 48,000. So you add back 48,000 here. Bad debts written off. Bad debt is allowable. Bad debt is allowable, but what is not allowable is general provision for bad debts. But bad debts itself is allowable. Business premises rent is allowable, and salaries to employee is also allowable. So out of the total amount for general expenses of 324, these 2 items are not allowed. So you add them back. You go to the next expenditure, which is legal expenses. Ordinarily is supposed to be allowed, but you go to the additional notes. You find out if there is an additional notes affecting that legal expenses. Note number 4 says legal expenses include acquisition of patent rights. Patent right is a capital item. So patent rights, that one is not allowed. So you add back 24,800. That one is not allowed. Drafting of sales agreements, that one is allowed. Negotiating sales contract, that one is allowed, it's related to business. Drafting the business against trade, defending the business against trade dispute. Trade dispute is not allowed. Trade dispute. So any legal cost in relation to trade dispute is not allowed. Any legal cost in relation to trade dispute is not allowed. 42,600. Mortgage interest for Mark. So when it comes to partnership, any benefit that's any payment in regard to the partner's benefit, that is partner is to benefit the partner is not allowed. So mortgage interest here, mortgage interest. So this is for Mark. That is not allowed. How much is it? 140,000. 140,000. And then defending a partners around tax assessment. Wrong tax assessment not allowed. Wrong tax. Any expenditure that is taxed is not allowed. 94,600. Conveyance fees not allowed. That is tax. Conveyance fees. 125,800. Tax consultant fees. Tax consultancy fees not allowed. So that is 72,500. So that one you add back. So after that we have salaries to partners. Salaries to partners not allowed. Salaries to partners not allowed. 450,000. Drawings by partners not allowed. Drawings not allowed. 100,000. Commission to partners not allowed. Commissions to partners not allowed. Any payments to partners not allowed. Commission to partners not allowed. Commission to partners not allowed. 250,000. So you add back 250,000. Interest on partners' capital not allowed. Interest on partners. Interest on partners' capital 250,000. Sorry, interest on partners' capital. The commission is the 180,000 here. This one is 250. Purchase of furniture not allowed. Purchase of furniture not allowed. Purchase of furniture 96,000. Donation to poverty commission not allowed. Donation to poverty commission. Donation are only allowed to charitable institution, so that one is not allowed. We have construction of fire exits. Fire exits, that is a capital item. Fire exit, that is a capital item, 36,400. So out of those expenses that were deducted, those ones are not supposed to have been deducted. So we call them disallowable expenses. So we add them back. We add them to, they're supposed to be they're supposed to be added to the profits. So we check other notes. We had some other notes. We see whether how they affected the profit. For instance, note number, before we can proceed, we check note number 1. Note number 1 says gross sales include the VAT at 14%. In addition, 10% of sales before VAT represents closing stock. The stock had been overstated by 20%. So when you include VAT in sales, it means the VAT has also been treated as income. So it means it has inflated your sales value, which means you have enhanced your profit. So that one is supposed to be deducted. So VAT is not an income. When it is included in sales, it's supposed to be deducted. So now what it means here, so we have the sales figure here. The sales figure, the total amount of sales figure is 36,000. So according to the question, according to the instruction, according to the instruction, this figure here is equivalent to 114%. It is inclusive. So we want to know what was the VAT amount, 14%. We're going to deduct it from. So we take 14 out of 114 times 2, 736,000. We want to know how much was the VAT in that amount. We want to know how much was the VAT in that amount. So this one is going to give us 14 divided by 114 times 27, 36,000. So this is 336,000. 336,000 is the VAT amount in the sales. So then the net sales without VAT, net sales without VAT is going to be 27, 36,000 minus 336,000. So this one is going to give you, so 2273, 6,000 minus 336,000. So this is 2,400,000. So this is the value of sales without VAT. This is the value of sales without VAT. The same note says that in addition, 10% of the sales before VAT, sales before VAT, which is this one, that is 22,400,000, before represents closing stock. So closing stock here. So this is closing. We are dealing with note number 1. So closing stock here is going to be 10% of 2,400,000, which is the same as 240,000. So that is the closing stock, 240,000. It has been overstated by 20%. So this figure here, this figure of 240,000, which is the closing stock, is overstated by 20%. So in other words, it is same as 120. So when you overstate your closing stock, what is the implication to your profit? What is the impact to your profit? When you overstate your closing stock, the impact is it enhances your profit. For instance, just let's do a simple analysis here. For instance, if you have your normal sales to be 10, that is your normal sales to be 10. And then you have your normal opening stock to be 2. And then purchases here to also to be 2. And then closing stock is 1. So the normal gross profit, which is our profit, 2 plus 2 before minus 1, it will be 3. So our gross profit here, normal one, will be 7. Now, supposing we overstate our closing stock by any, the impact is the same. We overstate it by either 1 digit. So instead of indicating as 1, we indicate it as 2. So it will be 2 plus 2, which is 4 minus 2, which is 2 here. So if you overstate your closing stock, then it means the overstatement is treated as income. So both these two items here, we're going to deduct them. We're going to deduct them from this profit. So the VAT in sales and the overstated closing stock. That is note number 1. And then we go to note number 5. Note number 5 there. So let me repeat for the sake of those ones that might not be following. We are saying note number 1, they have told us that the sales value indicated in the income statement, this value here, includes VAT of 14%. So it means it's equivalent to 114%. So the VAT in sales, VAT is not sales. So when it's included in sales, we need to determine it and eliminate it from sales. So when you inflate any figure in the sales, then it means you've enhanced your profits. So that one, we're going to deduct it from the profits. So here you have come and determined the 14% of this, the VAT amount in sales, which is 336,000, by cross multiplying. And then now we need to get the net sales. So the net sales is 2,400,000. So you take the sales value minus the VAT. This is the net sales. And then out of this total net sales here, 10% of it represents the closing stock value. 10% of the net sales, in other words, sales without VAT, represents the closing stock, which is also overstated by 20%. According to analysis here, simple analysis, which you can be doing in case of overstatement, it tells us when you overstate the closing stock, it means you have increased your profit. So that one is also an item to be deducted. And then we also go to note number 5. Note number 5 says the purchases represents 40% of gross sales figure, 27. So here, this is note 1. This is note 1 here. This is working for note 1. And then note 5. Note 5. So note 5 says the purchases represent 40% of the gross sales. So the purchases figure is 40% of the gross sales plus VAT. So 27, 36,000. So that one is give us the value of purchases. So let us first get the value of purchases. Let us first get the value of purchases. Let us first get the value of purchases. Get the value of purchases. So that is 1094,400. So 40% is 1094,400. So 1094,400, that is the purchases. So what about it? The purchases had been understated by 25%. So this value here, this 1094,400 is equivalent to 75%. So when you understate your purchases, let us go back to our analysis here. We have said that purchases, the normal purchases to be 2. So let us understate it by 1. We want to see the impact on our gross profit. So 2 plus 1, that is 3. Minus 1, that is 2. So 8. So when you understate your purchases, then it also means you've treated that one as an income. So you have treated that one as an income, so you're supposed to deduct. So all those items, they are deductible items, we're going to deduct. So that is how we do it. And then we continue. So after dealing with the expenses, you come here and you less omitted allowable deductions. So there are those deductions that are supposed to have been deducted, but they are not yet deducted. How do you know them? They are not among the list of expenses, yet they are supposed to be there. So the expenses that are supposed to have been deducted, but they are not deducted. Why? They were omitted. Investment allowance. So you write here investment allowance. The first item there we have is furniture. So you take their furniture. So they did not claim investment allowance on furniture because it is not indicated in the list of expenses. So the rate is 10%, and the value of furniture that was acquired is 96,000. So you claim or you deduct that one. So that one is 9,600. You deduct that one. So they also partition. It's also 10%, and the total value for partition is 64,000. So 6,400, you also deduct that one. And then they also hide fire exits. Fire exit, that is a building, so which qualifies by 10%, 10% of 36,400. So that one is 364, 3640. So you deduct that one. So that is investment allowance, it was omitted. And then after that, you less non-taxable non-taxable income. So those items that are treated as income, yet they are not taxable. So one of them is VAT in sales. So you less VAT in sales. We have already determined it is 336,000. So 336,000. So you less it. And then you also less overstated closing stock. Overstated closing stock. Overstated closing stock is 20 over 120 times 20 over 120 times 240,000. 20 over 120 times 240,000. 20 over 120 times 240,000. So that one is 40,000. So you deduct 40,000. And then there is also understated purchases. Understated purchases, which is 25 over 75 times 1094 400. 1094 400. So understated purchases, so 25 divided by 75 times 1094 400. So that one is 364 800. So 364 800. So that one you deduct. And then the next item those are non-taxable business income. Then you go to the list of income that were considered for the period. So we also have unrealized foreign exchange gain. That one is non-taxable. So you less unrealized foreign exchange gain. Unrealized foreign exchange gain, which is 16,000, that is non-taxable. So you deduct that one. And then insurance, okay, over provision for bad debts, over provision for bad debts. Over provision for bad debts, which is 34,000, so you deduct that one. Over provision for bad debts. And then interest on drawings. Interest on drawings. That one is non-taxable, 45,000. And then you less income from specified sources. So these are income that are taxable, but they are not supposed to be included together with the business income. So they are specific income, they are also taxable. So in Kenya here, 5 sources of income are considered taxable income by the government. One of them is employment income, investment income. Investment comprises of interest and dividend income. And then we have farming income. We have rental income and business income. So those are the 5 sources of income that are considered taxable in Kenya. So when they are there, each and every source should be indicated separately. You don't mix them together. You don't combine them together. So where we have investment income, for instance, combined together with the business income, for purpose of accounting, they do that. But for purposes of tax, you need to show them separately. So we have investment income indicated or included in this business income. So you're going to deduct dividend from Haki Cooperative. So dividend, Haki Cooperative. Dividend Haki Cooperative, 42,500. So you're going to deduct 42,500. So here you get the adjusted taxable income. Adjusted taxable profits to close. So when you do that computation, you get the adjusted taxable profit or loss. So we can do it. So you take 9, you can even help me, 994. You add 64,000. So the adjusted taxable income here, according to my computation here, it is 1,885,260. So that is the adjusted. So I want to delete this section here so that I can get space for distribution. So you can take a photo of these notes here. So I want to do away with this section here. So please, if you are interested, you can get a screenshot of it. So now here, you're going to prepare what we call distribution schedules. Partners distribution schedule. So partners distribution schedule.